What's up guys, welcome to Millennials with Money, the channel that helps you take control of your finances and create a bright financial future. I'm Johnny, and if you like today's video, please leave a like, click subscribe and the notification bell, and tell another millennial. So millennials and young people today are generally criticized for their attitude towards saving, towards spending, and towards money in general. So I decided to have a look on the internet to find out what the internet is really saying about our generation and the generation after us. And actually, I didn't really get a clear answer as I expected. For example, I found some sources that saying that millennials aren't saving money and that aren't bothered about saving. I found some sources saying that millennials actually want to save but don't have the financial capacity to save. And I found other sources that say that millennials are doing better than other generations at saving. The reality of the situation is this. If you're not saving, you need to find a way to start saving, no matter how small the amount that you save. And if you are saving, what if I told you that you're not doing enough? Now, before you all start throwing stones at me, don't get me wrong, it's great that you can save money, particularly in today's tough economic climate and with the conditions of the labor market into which a lot of us young people have entered. And before I go into this video, let me say that if you're saving money just to be able to put aside a few months worth of expenses, then what I'm about to say doesn't apply to you. This video is for the people that want to build their long-term financial stability and wealth and make the most out of their savings. So if you're not doing enough, what else can you do? Let's get into the video and I'm going to show you and explain. Now, to illustrate the points that I want to make in this video, we're going to use a very simple example. Let's say that you save 1,000 euros a year over the course of 10 years. That means at the end of 10 years, you have 10,000 euros. With your 10,000 euros, because you've been taught that saving is a good thing and that you should put your money in a savings account, that's what you decide to do. Now, savings accounts in the traditional sense are considered to be very low risk. That's because you typically generate a regular return on your income, you can't lose more money than you put in, and in most countries these days, there exists some form of financial protection scheme should something happen to your bank. The regular return that you receive on your money is called interest, and it's effectively the bank saying thank you for you and giving you a financial reward for trusting them with your money. Before the 2008 financial crisis, there were some pretty generous interest rates offered by banks around the world. But since then, they've been reduced significantly and they've not returned to the levels that they were pre-2008. I had a quick look on the internet to find out what the typical rate of interest is that you can expect from a bank in the EU. And as you can see on this page, depending on the country, that can range anywhere from typically 0.3% to 1.1%. Going back to our example, let's assume that with your 1,000 euros, each year you put that in a savings account that offers you 0.5% annual interest rate. Let's also assume that that interest is compounded. That's to say that the interest each year is calculated on your total contributions plus any interest you've earned in prior years. So in our Excel file with these assumptions, you can see that after 10 years, you would have 10,279 euros. Nice, right? You just keep bringing your money each year, and at the end, you've got almost 300 euros free just for having the money in the bank. So far, so good, right? Well, let's add another element into the mix. Let's add in the effect of inflation. The inflation is the rate at which the prices of goods and services in the economy increases. It's also another way of saying the rate at which the economy is growing. So, to explain this a bit more, let's take an example. I grew up in the UK, and in the UK we had these small chocolate bars called Freddo Frogs. They were great and I loved them. They were fantastic. Back in the early days of Facebook, when I was in my teens, I remember seeing a page which jokingly said that you could measure the rate of inflation based on the price of Freddo Frogs over time. So I decided to investigate this and take a look on the internet to see if there was any data, and I did find something. Have a look at this. So if we take a look at this graph, we can see that over the years, the price of a Freddo Frog has consistently increased to keep pace and even stay ahead of inflation. What you can see here is the green graph, which shows the theoretical price evolution of a Freddo Frog had it risen in line with the UK inflation rates year on year. The purple graph shows the actual price of a Freddo Frog on the shelves in the shops, and you can see that it's actually higher than the green graph. That's to say that sometimes the prices of goods and services can be increasing at an even greater rate than the inflation rate of the economy. And it's not just Freddo frogs which are impacted by this. If we take a look at the same graph for a Mars bar, which is another bar of chocolate which is available in the UK, we can see the same trend. What's even more alarming is that the net weight of a Mars bar has decreased over time, which means you get less for your money. Shocking. And that's the point I'm getting at, that over time, money loses its purchasing power. Whereas in the year 2000, you could buy 5 Freddo frogs with 50 pence, in 2018, you could only buy 2. So in the first example, I showed you the nominal value of your money and how it grows over time. That's to say, the numbers that you'll see on your bank statement for your balance and the interest earned. Now let's add in a second table which shows the real value of your money. Now this shows what your money will be worth in the future based on today's terms. So in this example, that would be 2010. We're looking at how much our money will be worth in the future based on how much it's worth in 2010. So what do we see in that second table? We see that in today's terms, our 1,000 euro contributions are actually worth less as time goes on. Not only that, but our closing balance in real terms is always less than the total amount of money that we've invested over time. And here is where the problem becomes apparent. We can see that for the majority of years within that 10-year period, the inflation rate was often higher than the interest rate that the bank was offering us. That means that our money is losing value quicker than it's generating interest. So whereas you think you've gained 300 euros, in real terms, you've actually lost 500. And though that may not look like much on the graph that I'm showing you right now, the more and more years that you continue to do that, the more and more value that your money will lose over time. So where do we go from here? Fortunately, savings accounts aren't the only products that banks and financial institutions offer to their customers. If you take a look on your bank's website, I'm sure that you'll see that they're advertising investments in funds and investments in stock brokerage services. Now, yes, these come typically with a higher risk as they can result in a partial or complete loss of capital that you invest. But typically this risk is reduced over the longer term, and over that longer term, the returns produced are significantly greater than a savings account. If we take the example of the S&P 500 index, which consists of the top 500 companies in the US, you would see that over a 90-year period, your annualized average return would be 9.8%, which is much greater than what we were seeing in our savings account. And yes, you can invest in the US market from your broker or your bank based in Europe. In addition, there are many companies listed on the world stock markets that will pay you dividends simply for investing money with them. This works similar to the principle of interest, where the company thanks you for trusting them with your money. And this dividend can come in the form of either a cash payment or with new shares in that company. And a realistic expectation for the return on your investment to this could be from 4 to 5% or even upwards, depending on the company and at what price you buy their shares. In both of these examples, the return that you make on your investment is significantly greater than in a savings account. And in addition, not only does it beat inflation, it starts generating money for you. That's what we call passive income. And passive income is a key step in building long-term sustainable wealth. Now, if you are interested in investing and are looking to get started, why not check out Trading 212, which is a platform that offers a range of US and European stocks with commission-free investing. In addition, if you use my sign-up link, which is in the description, you will get a free share, and so will I, when you deposit £1 or €1 on the platform. Please, however, do your own research before investing. It's important to consider your risk profile and your financial goals to determine whether investing in the stock market or in funds is for you and your risk profile. And if you decide that investing is not for you and you prefer to stick with a savings account, then even though it's not a great return on your money, some return is still better than nothing. And as I said at the start of the video, savings accounts are actually really good if you want to build an emergency fund and just put a few months of expenses to one side so that you can have quick and easy access to it without losing too much value. So let me cover the key points that we covered in this video. We saw that money loses its purchasing power over time due to a rise in the cost of goods and services in the economy, known as inflation. We saw that banks don't typically offer high enough interest rates for our money to be able to keep pace with this inflation, and that if you want to beat inflation and develop long-term wealth, you should consider investing in the stock market or funds, which typically offer a much greater return. So thank you for watching today's video. I hope you enjoyed it. Be sure to check out the Millennials with Money social media and internet pages. I'll see you on the next video, and let's get this money.